Diversification. What is diversification? Diversification is a risk mitigation strategy. The old proverb, "Don't put all your eggs in one basket," is the simplest way to describe diversification. Diversification is all about making sure your eggs are in different baskets in case something happens to one of them. So just how does the principle of diversification work? The theory is simple. You need to combine investments that have different return patterns so that large fluctuations in one area or individual investment can be covered by others. To build a diversified portfolio, you need to combine asset classes, equities, bonds, cash, or others, whose return profiles differ from one another. This way, even if a portion of your portfolio is declining, the rest of your portfolio is more likely to be growing, or at least not declining as much. Diversification is the closest thing we can find to a free lunch in finance. The magic of diversification is that you can take two risky assets, blend them, then reduce risk because they perform differently at different times. For example, equity and bond markets historically do not move in the same direction at the same time. By combining them, we can create a robust portfolio that will reduce the overall risk without diluting the opportunity for healthy, long-term returns. Why diversification is important? We need diversification because we can't predict the future. If we could, then we would simply pick the stock or fund that would be the best performer by the end of the year, sit back, and watch it happen. The first step toward diversification is admitting that nobody can predict the future. Diversification protects your money when you're wrong. The secret is to minimize the chance of large losses, which is one of the key benefits of a diversified portfolio. More volatility usually means greater uncertainty. We don't like uncertainty. Diversification helps you to maintain healthy long-term and consistent returns, while at the same time reducing the volatility of the overall portfolio. Finally, diversifiers need to think long-term. It's not about having the best portfolio in town. It's about having a portfolio that's aligned to meeting your goals.